Hello and welcome to the Lolly Investor Programme. As I promised last time, this week I'm going to talk about risk. Investing is all about getting the right balance between risk and return. Broadly speaking, the less risk you take with your money, the smaller the rate of return you will get. The safest thing you can do with your money is to keep it in cash. However, as we saw at the start of the series, keeping your savings in cash will not do you any good against the threat of inflation, which is steadily eroding the value of your money. Nor will it help you cope with a long life in retirement or the fact the state pension is being cut to the bone. You have to speculate to accumulate, as the saying goes, and that means putting money into the stock market in a sensible way. I said sensible. Don't make the opposite mistake of thinking that more risk inevitably means a greater return. Remember, banks built up lots of risk in their businesses, and look what happened to them in 2008. Last time I talked about bulls and bears. These two words are used to describe investors when they are either happy or bullish to take on stock market risk, or when they are unhappy or bearish to take on stock market risk. However, despite what you may sometimes hear, risk is not a switch that you can turn on and off. It is important to think about your attitude to risk before you invest so you get it right. It's the can I sleep at night factor. It's all very well saying to yourself, my pension fund has 30 years to go, I don't mind taking a lot of risk, if you find yourself worrying about your fund investing in Mongolian financial futures. You need to choose an investment approach that you're comfortable with. Are you a cautious investor or an adventurous investor? See Why Money, the website where you can find the lolly, has a useful tool that makes the point around risk and return really well. It shows the wide range of financial returns that you could have got from different types of funds over the past 10 years. Funds investing in Latin America and Brazil on average generated the best return of nearly 482%. That's a stunning performance. But if you look at the maximum loss you could have suffered at the worst point during the past 10 years, you'll see it is over 50%. If that makes you uncomfortable, don't put all your money in Latin American funds. Look at mainstream funds investing in the UK. They grew investors' money by 75%, far less, but they did it without any currency risk as all the investments were bought in pounds. And at the worst point in 2008, investors suffered a slightly smaller maximum loss of 42%. The inescapable fact is shares are a risky asset class. That is why people often look at bonds as well. Although the long-term returns from bonds are lower than shares, as a general rule they don't jump up and down quite so much. Even the riskier bonds from emerging markets have provided a much lower 10-year return than we saw with equities, but with a lower maximum loss. This makes them a useful addition to your pension fund. Adding bonds alongside shares can, in theory, improve your risk and return. You can get the growth from shares with the steadiness of bonds. That's the theory, and there is some evidence it works in practice. Take a look at mixed assets funds investing in shares, bonds and other assets. There are different kinds of mixed asset funds, but the most interesting are those called absolute return. This name means they aim to provide a positive return over, say, a 3-year period. Over 10 years, they've generally done better than funds investing in UK shares, and they've done it with a lower maximum loss. I think this shows that investing is never easy, but by thinking long-term and mixing cautious investments alongside more adventurous ones, you can still aim to do very well.